Houston's economy has been absolutely booming over the past few years, but that wasn't really translating into significant apartment rent growth until now. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Houston update. When you look at employment change over the past 4 or 5 years, no market in the country has done better than Houston. Take a look at this chart showing total employment levels in Metro Houston over the past couple decades, and you can see that there are more jobs in Houston today than ever before. Just in the past year, the Metro added another 89,500 jobs, growth of 3.5%, some very, very impressive numbers. However, despite those really attractive economic numbers that put Houston in a league of its own, the Houston apartment market really hasn't kept pace with the national averages or even relative to what we've seen in some other Texas markets like Austin and Dallas. And this has been particularly true on the rent growth side. Take a look at this chart showing annual rent growth change in Houston versus the MPF 50, which is the weighted average for the top 50 largest markets nationally. And you can see that from fourth quarter 2009 through the second quarter 2012, Houston underperformed against the U.S. average for large markets every single quarter. But that changed in Q3 2012. For the nation as a whole, rent growth levels are trending downward, but for the Houston Metro, rent growth levels are trending up to 5.5%, ninth best in the country among large markets and the best in Texas. And that 5.5% rent hike number, it ties Houston's best over the past 2 decades, matched only by an equal jump in Q2 of 1998, and you can see that on this chart here. Houston rarely sees much rent growth. The only other time that it's got to even 5% was in Q1 2006, and at that point, the rent growth number is driven up by an influx of demand coming from Hurricane Katrina evacuees. So, what is driving the rent growth that we're finally starting to see? Well, it's a pretty easy answer. Lots of demand and not yet a whole lot of supply. 14,777 units absorbed in the past year compared to just 3,222 units completed. And that demand is an impressive number considering that home sales are also up significantly over the past year, although of course still not back to pre-recession highs. So there's a lot of housing demand that's out there, all thanks to very strong job growth. And before you think that this market is undersupplied, and by the way, don't worry, there's plenty of that on the way, but this market has also been, for lack of a better phrase, under-demanded over the past few years, particularly in the most affordable submarkets and in bottom-tier units. So even with that big gap between supply and demand, occupancy still isn't in great shape. Now, it is strong by Houston standards at 93%, but that's 240 basis points below the national average. Now, it is getting better. Occupancy is up 40 basis points in the quarter and 200 basis points year over year. And let's give a quick look at the construction story. This chart shows you the long-term trend in the number of units actively underway, as well as the number of multifamily units permitted annually by quarter. Permits are the purple line, and you could see that we're quickly returning to those long-term normal levels. Construction is still lagging behind a bit, but no doubt it'll catch up. 8,211 units currently underway, and more than 80% of that is concentrated in the urban core, inside the inner loop or in the Galleria area. Lots of high-end product going up in those spots. But these are the spots where apartment fundamentals are in very strong shape. Take a look at these performance stats. Big rent growth over the past year in all of these spots, led by a 10.5% hike in the West Inner Loop downtown submarket, and strong occupancy rates all around, 95 to 96% and north of that. So, can all this historic momentum be maintained going forward? Well, maybe not quite at this pace, but we think that we're in for another strong year for revenue growth in the Houston apartment market. Job growth is expected to remain strong, and while supply is increasing, it won't yet be a very significant factor until we get into 2014. So we're expecting occupancy to increase another 100 basis points, 94%, and for rents to jump 4.8% year over year. So that wraps us up for Houston. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.